Good morning, everybody. Welcome to my channel where I'm talking about all things related to cross-border tax. In today's video, I'm going to discuss the Canadian departure tax. So, what is the departure tax? It is a tax that you have to pay when you immigrate from Canada. Immigration occurs when you sever your residential primary ties with Canada. Your primary ties with Canada are your home, the location of your spouse or your dependents, and your personal property. Sometimes you also have to consider secondary ties with Canada, such as bank accounts, investments, driver's licenses, or your social connections. Residency itself can be a murky issue, and I addressed that in a previous video. Anyway, the Canada Revenue Agency will look at all these factors to determine whether you are still a resident of Canada for tax purposes or not. So, how do you become a non-resident of Canada? It's not just as simple as packing your bags and jumping on a plane. You have to show that you've cut your ties with Canada and established new ties with another country. It usually happens on the date that you leave Canada or the date that you become a resident of the other country that you settle in, whichever is later. But like I said, it can be a murky issue, especially if your move takes place over a period of time. So here's where departure tax comes in. If you're considered an immigrant of Canada, then you'll be deemed to have disposed of your assets at their fair market value on the date of your departure. It's called a deemed disposition, and it might result in a capital gain or a loss because you have to report it on your final resident Canadian tax return. Why does the CRA do this? Why do they deem that you sold your assets when you actually haven't sold them? It's because they want to tax you on any increase in value that occurred when you are a resident of Canada. They don't want you to evade or avoid paying tax by moving to another country and then selling your assets once you're there and recognizing all the gain in this new country. They also want to prevent double taxation, so you can adjust the cost of your assets for future sales in this new country. So just talking about the different assets that are subject to departure tax, most assets are subject to departure tax. Common ones are shares of your corporations. So if you own a corporation, either your own private corporation or you own investment shares in a public company or things like that. So those are subject. Interest in partnerships and trusts. Real estate that's located outside of Canada. So if you have, an investment property in another country, as a Canadian resident, you're subject to capital gains on any increases on that property. And then, of course, personal use property like artwork, jewelry, furniture, and so on. So those are some examples, but there's lots of other types of assets that might be subject to departure tax. Some assets are exempt, and there are some key issues there. Real estate property situated in Canada is exempt. So that's a big one. If you leave a house behind or you have some rental properties that you leave behind when you leave Canada, you do not have to report any gains on that. Canadian business property like inventory can sometimes be exempt, especially if you have an existing business that continues to operate in Canada. And then also the pension plans like RRSPs, RIFs, RESPs, RDSPs, TFSAs. There's some special rules depending on the country that you're immigrating to, but they're generally not reported for departure tax. So those are some examples of exempt. And there's there's other types of assets that are exempt from departure tax, but it depends on their characteristics. Okay, so calculating departure tax. So the date that you leave Canada, on that tax return, that year, when you file your Canadian tax return, you have to list, first of all, you have to list all the assets that are subject to departure tax on a Form T-1243, deemed disposition of property by an immigrant of Canada. Then you also attach a Form T-1161, which is a list of properties by an immigrant of Canada. Going back to the T-1243, you're indicating the fair market value and the adjusted cost base, what you originally paid for that asset, the fair market value of the date of your departure. which is basically the amount that you would get if you sold that asset on the open market. And then your adjusted cost base is your cost, what you paid for it, plus any additions, minus any deductions and write-offs and so forth. And the difference between the fair market value and your adjusted cost base is your capital gain that you have to report. How do you determine the fair market value of your assets? It's not easy sometimes, depending on what it is. If it's a publicly traded commodity like shares in a company, that's fairly easy. But what I work with a lot are your own private corporation, and that's really hard to determine the value. There's different ways of doing it. You can hire an appraiser or evaluator. They can give you a certified answer that may be accepted by the CRA. You keep those records and documents to support that valuation in case the CRA questions it. And then how do you determine what you're going to pay? It depends on the capital gains. It depends on your marginal tax rates. But you pay it just like a capital gain tax. You would if the same way that you would pay it if you were ordinarily a resident of Canada. In general, your capital gains are only 50%. Only 50% of your capital gains are taxable in Canada, but there are some exceptions where your capital gains are exempt, fully exempt. So let's talk about that here in a little bit. How do you reduce your departure tax? Yeah, there are some ways you can reduce it. You can start with claiming any available deductions. Capital losses that you have carried forward from previous years, so you can maybe think ahead and start triggering some capital losses in your investment properties so that you have some of that to apply against capital gains. And then there is the big one is your lifetime capital gains exemption. So if you have qualified small business shares or qualified farm or fishing property, you can claim that on that last year that you're living in Canada, trigger that capital gain exemption, and not have to pay any tax because it's a qualified small business share or a qualified farm property or fishing property. And also you can claim the principal residence exemption on your home. So your home itself is not taxable. You can still report the disposition of it, but you can claim that principal residence exemption. The other big one to think about is that you can elect to defer or put off or postpone the payment of your departure tax until you actually sell the asset. So let's just say you have this art collection that's going to stay in Canada. It sits in Canada, and you leave, and you report this deemed disposition of this art collection, and it triggers taxes of $40,000, let's say. You can elect on a Form T-1244 to defer and postpone paying that $40,000 of taxes until you actually sell that sell that art collection. What you do with that is you have to provide some security to the CRA and let them know that you're deferring this $40,000. Here's a cash deposit or a letter of credit or something down that line, and then you need to keep on filing information returns until those deferred taxes are paid. And then when you eventually do sell this art collection, then you do have to pay that tax. Obviously, this is something that you should be planning ahead if you're planning to leave Canada to minimize your exposure. There's a couple other things you can think about doing is selling your assets before you leave. You can transfer some of these assets to family members that stay in Canada if you're, like an advance on an inheritance or gifting to family members or things like that. Also, you can consider donating some of your assets to charity. So yeah, departure tax can be a complex, costly issue for Canadians that are leaving the country. It's really, really important to plan ahead, to ask for professional advice before you make the move. A common mistake with my clients is that they first move and then they call me and ask for help, which is fine. I can help out with that, but it's always better to do that thinking and planning before the move. If you do have questions about departure tax, if you have questions about any other tax topics, if you want me to address any issues specifically on cross-border taxes, just let me know and I'll be happy to address those. Thank you for watching, and don't forget to subscribe for more videos like this one. Have a great day.